Hi, welcome to the Simply Investing Dividend podcast. My name is Kanwal Sarai, and in this episode, I'm going to be sitting down with Prakash, who is the founder of dividendpower.org. In part one, we are going to talk about the current challenges of investing in today's economic climate. And in part two, Prakash is going to share with us some of the stocks that he's currently interested in. And along with his experience and insight, which we're going to get in both part one and in part two. So let's get started with part one right now. Prakash Kohli is a self-taught investor and blogger on dividend growth stocks and financial independence. You can find his writings on Seeking Alpha, Business Insider, NASDAQ, Value Walk, Forbes, and other leading financial blogs. He also works as a freelance equity analyst with a leading newsletter and platform on dividend stocks. Prakash was recently ranked in the top 1% of financial bloggers as tracked by Tip Ranks for his articles on Seeking Alpha. Prakash, welcome to the Simply Investing Dividend podcast.
Thank you, Conwal. It's nice to see you again.
Good to see you as well. Nice to be chatting today. So let's get started with sort of the beginning, Prakash. How did you get started with dividend investing?
So it really started as a hobby. Personal investing was something I was interested in. And like many investors in stocks, I started in mutual funds and then I transitioned to stocks. And eventually that transitioned to being a blogger and financial influencer.
So what made you transition from, because I was the same way, I was invested in mutual funds many, many years ago. What made you go from that to dividend stocks? What was the catalyst there?
So I had some interest in kind of doing it myself. I'm kind of interested in learning more and in figuring things out. And it was kind of the early 2000s, and there was a lot of people starting kind of their own financial sites. And, you were seeing these on the internet as you would search for them. And, I was thinking, hey, I could try this on my own. And, during the dot-com crash, there was definitely some mutual funds I was invested in that did not work out so well because they were overinvested in the dot-com era tech stocks. And so I was thinking, can I do this better? And so, yeah, that's how the real genesis of the whole thing started.
That's incredible. I mean, it sounds like we started in sort of the similar time frame, because I was starting in 99 and 2000. So we survived the tech bubble and we saw what happened to the tech stocks as they crashed. So that's interesting. Do you remember your first dividend stock? Do you remember what you bought?
Yes, I do. So I don't own this anymore. At the time, I owned a stock called Kinder Morgan Partners, and it's called KMP. The company no longer exists. It's now become Kinder Morgan, and so it's KMI. It had a restructuring, and KMP was a great stock. It was an MLP, a master limited partnership, so it was an oil pipeline, and it paid a lot of dividends. But in 2015 around, it cut its dividend because they used too much debt to finance growth, and they couldn't, they were issuing equity and they couldn't pay the dividend. And so that resulted in a cut. And at that point, I was pretty much a dividend growth investor, and a cut meant sell. So I sold the stock and didn't look back. In hindsight, I mean, there was a lot of people who were saying, "Hey, stick with it," but the stock really hasn't gone too much anywhere since that time. It's kind of traded in a range, and so that one is it was good while it lasted, but in the end, it didn't work out, right? So because you're kind of looking for the long term, decades long holding as a dividend investor, right? So
yeah. It sounds like you made the right decision, because I've come across I've met a lot of dividend investors that feel the same way. When they see a dividend cut, that raises a red flag. And a lot of them will automatically sell. Some of them will say, you know what, let's wait another couple of months. Let's wait another quarter. Let's see what happens. And then they make a decision. If there's another cut, a lot of them are going to sell. I'll share my quick story with GE, right? And I didn't sell. I still own GE today. And they made a number of announcements, a number of dividend cuts over the years. And in hindsight, I wish I got rid of it, because now I'm still hanging on to it. And now it's just, I mean, it's now I just hate to lose money. And now I'm like, you know what? I'm just going to keep it until who knows what's going to happen. I don't know if it'll ever come back to the where it was. GE was a conglomerate, a huge company, right? I don't know if it's going to come back to where it was.
Yeah, I mean, I'm not an investor in GE. GE, I mean, was a great growth stock, not just for capital gains, but for dividends. I mean, it made a lot of millionaires, I think, in that time. I mean, Jack Welch was the CEO for a long time. Yeah. But it kind of, the bottom fell out, and so, they cut the dividends, and the company's going to be different going forward, but it's hard to say when it will be back. Yeah. But yeah, I mean, dividend cuts are a tough thing. I mean, when to sell is a hard question. And, it's just sometimes, during the pandemic, the cut was, for a quarter, maybe 6 months or a year, and they came back. But in other cases, a dividend cut can be for a long time. And you know how it is, Conwell. I mean, once they cut that dividend, I mean, people sell and the stock price drops as well, because they're holding on to that stock for a reason, right? So, yeah.
Yep, absolutely. And so, Prakash, I know in March of 2020, when the COVID hit, and I remember your site, you were tracking, and I'm not sure if you still are, you were tracking all of the U.S. stocks that were cutting their dividends. I mean, that blog post, I think, went viral. We had so many comments on that thing. Yeah. Are you still tracking that today, or where is that?
Yeah, I mean, that was probably what put Dividend Power on the map. I mean, that tracking of the dividends. I mean, we were doing it weekly back then. So we are still tracking them. We're doing it about monthly now. In fact, I just updated the post today morning with about 3 or 4 more cuts. And so we did track a lot of U.S. stocks. We have a few ADRs in there, so Canadian and European stocks, which do trade on U.S. exchanges. And, it was useful for my readers as well as a lot of readers. I got a lot of great feedback, a lot of great, input from people. And it really was a post and, information that kind of made my site as well and kind of put me on the map as well. And so, we still do it. We still have that table. You can still go there and you can still search through the table and find out, if your company had a dividend cut. And we do still show when it was done, the initial dividend, the current dividend, and we link to the source the best we can. Yeah.
That's incredible. I mean, it's an incredible service because I don't know anyone else who was doing this at the time. I still don't know anybody who was doing this. And it's great for you to track all of that. Is it easy for our audience to find that on your website? Can they just go straight to the website, or is there a specific URL?
Yeah, so they can go straight to the Dividend Power website. And then if you look at one of the drop-down menus up top, there's a dividend stock list. And we have dividend cuts and suspensions as one. We added a list called dividend increases as well. And that's kind of a rolling list within the past year. And you can search through the table on that. And then we have all the other lists that we track, which is like, kind of the dogs of the Dow, the dividend kings, the dividend contenders, etc., all the dividend growth stocks. And, those are amongst our most popular pages because it's all in one place, all the information. And it's good for investors who are just saying, hey, I want to see a dividend calendar, and it's right there for you, right? And so, and you can find, there's about 700-800 dividend growth stocks that are traded on U.S. exchanges. And so you can find almost all of them on those lists.
Oh, that's great. Now, I know there was a lot of companies cutting dividends back in March 2020, right? Disney comes to mind, Boeing, General Motors just cut the dividend to 0 back then. Now, if you look at the list today versus back in 2020, is it a smaller list now? I'm assuming some of the companies have started to resume their dividends, or is that true or not?
Yeah, that's correct. Many companies have reinstated their dividends, especially this past year. And so we don't track reinstatements or restarts of dividends on that particular list, but you could see it on the dividend increases list. So you'll see something went from 0 to some value, and you'll see it there. The economy has done well the past 2 years globally and in the U.S., and many companies were able to become profitable again. And in many cases, a lot of the cuts were from the energy sector. Oil prices went down. Real estate investment trusts also cut dividends because their commercial real estate wasn't being leased or they weren't getting rental payments, so they cut their dividends and so on. And so retail stocks, also restaurants, and in many cases they're back. A lot of these companies are now in much better shape than they were in March or April of 2020 or June of 2020, and so they're able to pay the dividends back. In some cases, they're much higher than they were before. They've reinstated and they've gone higher. So, unfortunately, they've lost their streaks, so they may not be a dividend contender or a dividend aristocrat anymore. So,
yeah. Now you mentioned we started the conversation with the dividend cuts, right? And that was for most dividend investors. That's the reason to sell, right? As soon as a company announces a dividend reduction, they sell. Are there other things that you look for before you decide to sell a stock, or is that it? As soon as the dividend gets reduced, you're going to sell it?
Yeah. So, sometimes it's proactive. You're looking, is the company struggling, with, poor revenue growth or negative, the revenue is decreasing, or even more importantly, earnings are decreasing. And there are some companies who just take on too much debt and they do it to do share buybacks or pay dividends. And that's just, it works for a short time, but it doesn't work over long term. Eventually the debt becomes unserviceable and they're doing it really for the wrong reasons, at least from my perspective. And, there's also, are they being disrupted? Is a company just, they're a successful company, but something new comes out, and that technology just disrupts their business and they get into trouble because they're not able to adapt. And so those are kind of things that you look for, but certainly dividend cut, balance sheet, is the leverage too high? That's a big warning sign. And then you're looking at the traditional dividend safety metrics, as you're well aware, the payout ratio, the dividend to cash flow ratio. Can they sustain, paying these, the dividends? And, everybody uses slightly different cutoffs, but let's say, you're at the payout ratio about 65, 70%, maybe 75%, just depending on what industry and your own personal preference. And beyond that, there's some risk to the dividend at that point. And, the same holds for dividend to free cash flow. And so some of those are some of the things that you look for. If it's temporary, or in your judgment it's temporary, then you may hold on to it. But if it's consistent and persistent over long periods of time, over a longer period of time, let's say, then you may sell it, right? And so, I recently exited a position in a company in 3M because I felt like their legal challenges were a little bit on the higher side, and I wasn't comfortable with it. Now, for some other people, that may be perfectly fine, and so it's just really personal preference.
Yeah, absolutely. And I think some people jumped on 3M because they saw it as an opportunity, right? The stock price came down, the yield went up, and they said, "Well, I'm going to jump in." But I guess time will tell if that's a good decision or not. Nobody knows.
Nobody knows. The yield is upwards of 5%. It's the highest in a decade, it could be a great entry point. But, for other people, they just may say, hey, I have other options, other things that I'd rather invest in. So,
yeah, absolutely. So we talked about some of the reasons why you may sell a stock. What are some of the reasons why you may hold on to a stock? Now, if we look at somebody like Coca-Cola, right? They've had an amazing streak of increasing dividends. Correct me if I'm wrong. I think it's over 59 years of consecutive dividend increases. So for a stock like that, do you just hold on to it and sit back, or how often are you monitoring your investments? How long do you hold on to your stocks?
Yeah, so I'm probably in more of a unique situation because I'm a financial blogger and writer, so I'm kind of I'm looking at stocks much more often than the average person. That's the same as you. You've got your newsletter, so you're looking at it daily. Most people, that's probably too much, and so. But you should definitely look at your stocks maybe quarterly or at least biannually if you're comfortable with the investments you have. Now, Coca-Cola is one of those interesting ones. It was a really great stock in the 80s and 90s from capital gains, but it's kind of been more of an income stock since then. But it's still growing. It's still growing and it's still paying dividends. And it survived the pandemic without cutting the dividends. I'm an owner. I don't expect it to because like maybe a tech stock would grow. But if it gets a few percent a year growth and it's paying that dividend, I'm going to hold on to it, right? And so because people are still going to be drinking soda, water, tea, etc. So yeah.
Absolutely. I mean, I own Coca-Cola as well. I've had it for many years. I had it before they did a split, maybe 3-4 years ago. I don't remember exactly. It was sort of recent. There was a 2-for-1 stock split, and as long as they're, like you said, the dividend is going up, it's an income stock. So I'm going to hold it for the income because that's what I'm. Eventually, the ultimate goal for dividend investors is to live off of the dividend income. So that's one of the
Yeah, that's
few
correct.
stocks
Yeah.
that it's good to hold on to. Yeah. So Prakash, there's one question that I always get from people. Um, you know, they'll say dividends are not guaranteed, right? There's no legal obligation for a company to pay you a dividend. So somebody like we saw that with Boeing and GM, and they cut the dividend when COVID hit. So if there's no real guarantee of dividends, I kind of know the answer, but I want you to tell our audience why would you still invest in dividend stocks then?
I mean, you're correct, Kunal. There is no real guarantee of dividends. Companies are not obligated to pay dividends, and many times the board votes on the dividend quarterly in the U.S. And in other countries, it's often biannually or annually, and it's a return to the shareholders, but they, as you said, they're not obligated to pay it. However, a company that pays a dividend is often reluctant to cut that dividend or not pay it once they start paying it, especially the ones with these long streaks. There's companies, like Coca-Cola, let's use as an example. They've paid a dividend for over 100 years now, and they've been paying a growing dividend for over 60 years. And it's a very tough thing for them, for that management, I think, to cut that dividend or to stop, because a lot of the investors in, these small investors like us, the retail investors, are owning that stock because of the very reasons that they pay a dividend or they pay a growing dividend. And then, there's exits at that point. I mean, if you ever look at a company that has cut the dividend for whatever reason, you can see on the chart all of a sudden there's a big drop that day or the next day because people are exiting. And so, I mean, companies do the smart thing though. I mean, if they cannot pay it, they will definitely not, or definitely kind of limit the increases. But at the same point, there's definitely a lot of expectations, let's say, that they continue paying it. So.
Yeah, absolutely. And I think it kind of forces the management to have there's a certain amount of discipline that you need, financial discipline, in order to continue to pay a dividend for a company like Coca-Cola, or there's other big ones, that have been paying dividends for many, many years. Johnson and Johnson is another one, right? That have been increasing dividends consecutively. Or maybe that's just my perception. I think it forces them to have some sort of financial discipline to pay it, because you can't. At the end of the day, you can't fake the dividend. It's a cash payment to the shareholders, right? The company has to pay that. You can play around with the earnings value and all that, with share buybacks and more shares. So those numbers can be played with, but the dividend it's cash getting sent out. Do you agree with that or not?
Yeah, I mean, I completely agree with that. Absolutely. So, I mean, yeah, dividend is a cash payment to the shareholders. And you have to have the cash on hand or the cash flow to pay it. And like you said, Conwell, I mean, the earnings, there's always these one-time adjustments and so on that happen for a lot of large companies because they're so large, and they have all these things so they'll have the adjusted earnings. But a dividend, I mean, there's really no way to avoid paying the cash to the shareholders. And so that's kind of a indicator of a healthy financial company if they continue to pay it or they continue to increase it. So it's not the only indicator, but it's definitely one of them, right? So
Yeah, absolutely. So what the current climate today. Let's talk about what's happening today in the economy, right? And we're all seeing this. The interest rates are going up. In fact, this morning in Canada, the Bank of Canada raised the interest rates again. And same in the US, the rates have been going up. And the economy is slowing down. And everything, the cost of goods is groceries, food, gas, everything's gone up. How do you, as a dividend investor, how are you dealing with this today in today's economic climate? Have you stopped investing, or what's your approach?
Yeah, I mean, I've been investing now for a long time. And so if I include mutual funds, it's, pre-dot-com era. And so I've been through more than one crash at this point. So I've definitely been through the dot-com crash, which was painful because it wasn't like a month or two. It was, 2 to 3 years where it took for the
Yeah.
stocks to come down, and it took a while to recover. And I've been through the Great Recession or the US subprime mortgage crash. And I've been through the COVID-19 bear market. And so this is really the fourth major, bear market that I've been through. And there's probably been a few corrections as well. So it's just part of investing. In the long term, stocks tend to go up, but there's always these painful downturns, and this is one of them. And the Nasdaq is in a bear market. The S&P 500 has been in a bear market. I think it's recovered a little bit in the past week, which has been nice. But it's just part of it. You can often find your best deals on stocks during these downturns, but it takes a little bit of strength and fortitude to invest in during when the volatility. Not everybody's used to these ups and downs. It takes some experience to do so, right? To invest in like environment like this. The economy is some people say it's bad, some people say it's okay, and everybody's saying they're expecting a recession, but interest rates are going up, but it's benefiting some companies, who rely on higher interest rates. I mean, banks are reporting pretty good earnings, and some other companies have seem to have pricing power. Coca-Cola just reported really great earnings, and some of these other packaged food companies are as well, because they are able to raise prices in this environment. And but at the same time, there's a concern that hey, it's going to get worse, and the interest rates keep going up. Certainly tech stockholders haven't done so great. And so, but, I think in the end, you kind of have to say, okay, be smart and invest in things that and that you think will come back when the economy recovers or when the market recovers. And so, and then the last thing is, at least in the US, I mean, unemployment rate is about 4%, right? And so a recession usually doesn't have such a low unemployment rate usually. And so that's not to say it's not going to rise, but, maybe it's just investors' expectations of lower interest rates that have been around a while have just disappeared. And we ended up with much higher interest rates, and they're just not sure how to adjust to it. So.
Mm-hmm. Yeah, no, those are all good points. I mean, yeah, it's a little strange that we're hearing with the economy slowing down, interest rates going up, everything's costing more, but yet unemployment is low. And I see it here too. I mean, when we're shopping at stores or restaurants, you can see they still have signs like hiring people. They can't find enough people to fill those positions. So that's really a big question mark for me, right? I don't know where we headed. And I know as investors, it's, nobody can predict the future. We don't know what's going to happen next week, next month, next year. We don't know how long this is going to last. So it sounds like, is it fair for me to say that you haven't changed your approach to investing, given the current climate we're in? Or are you just more cautious today than you were, let's say, a year ago? We continue our conversation in part 2, where you get to hear Prakash's answer to my last question, and we also discuss some dividend stocks that look interesting right now. If you enjoyed this episode, be sure to hit the subscribe button, click on the like button as well, and check out our website, simplyinvesting.com, for more information. See you next time.